Hello, my name is Matthew Herrett, one of the partners at Link Property Services. I'd like to welcome you to our latest market update. The sale and lease of sub 5,000 square metre buildings remains very strong, with demand continuing to exceed supply by a substantial margin in all markets. The result of this is continued upward pressure on capital values, face rentals, as well as downward pressure on letting up periods, and subsequently a reduction in lease incentives. There are numerous examples in Sydney where properties have recently leased and incentive levels recorded range between 0 and 5%. Additionally, we have witnessed an increase in the lease terms committed to by tenants, reflecting the additional leverage landlords now have. In the 5 to 10,000 square metre range, activity remains strong, however is less fever pitch than the sub 5,000 square metre range. Rents have grown and incentives too have come under pressure by a few percentage points. Most lease deals in this size range reflect incentive levels between 5 and 8%. Above 10 to 12,000 square metres and the market dynamics do change. The market remains active, however with larger footprints come longer lead times. The longer lead times bring additional competition in the form of the pre-lease market. The exception to this is the 3PL, transport and logistics industry. The sheer volume of goods imported that are needing to be warehoused as well as freighted around the country is driving their demand, which is underpinning speculative and turnkey construction in Western Sydney, as well as driving land sales. Over the last 12 months, those areas that saw the greatest rent growth and reduction in incentive and letting up levels were the Central West and South Sydney markets, typically for areas under 5,000 square metres. Both markets have very limited supply, exacerbated by the increasing pressure from residential and mixed-use development. Looking forward, the key changes we believe the market will see is the additional pressure on rentals in the plus 10,000 square metre size range. Industrial land values across Sydney have grown exponentially over the last 12 months, some areas by as much as 40 to 50%. This must translate to an increase in rentals as land valuations wash through the marketplace. With investment yields remaining firm and unlikely to firm further, rents need to increase to maintain asset values if yields will follow interest rate movements over the medium term to a softer level.